What's good, ladies and gentlemen? So, Powell and Trump. Who's the big D right now between those two? It's clear as day that Powell is running the show, not Trump. Not so long ago, Trump said that he wanted to get him replaced, and then the markets reacted. And of course, Trump's had a little conversation, or someone's pulled his ear and said, listen, bro, please stop with that. We've already got a problem with your tariff story. Don't even try and change the way things are operating right now. In today's video, I'm just going to break down why investors right now are anticipating that the Federal Reserve is not going to act when it comes to interest rates. And why is that important for us? And how can we understand where money is flowing right now between the asset classes that we focus on every single day, whether it's Forex, commodities, crypto, the indices, you name it. And we're going to help you, I'm going to help you understand what could actually be developing as we head into the infamous FOMC. So if you are new, ladies and gentlemen, stick around for this so I can break it all down for you so you are aligned with the madness that's about to unfold. Let's get with the program, gang. So we get it all started off with the day's news announcements, which will be the ISM Services PMI, which will be released at 3 p.m. UK time, 10 a.m. Eastern Standard. Now, why is this reading important? Well, it's going to give us an idea of where we are with the US economy. Now, it's an index that takes all of the opinions of purchasing managers. And what they do is they ask them, what do you think about inflation? What do you think about interest rates? What do you think about your current business practice as such? Like, have you got contracts coming in? What's your employment story? Are you releasing people? Where's your heads at with that? And then what they do, they put that information into an index and it pumps out a number. That number, if it's above 50, it tells us that the US economy as such is expanding. Well, if it's below 50, it tells you that there is a contraction. They are expecting 50.2. So any reading below that will give fuel to the Federal Reserve to justify why they shouldn't be cutting the rates, which leads me over to this story right here. In front of you, it says here that bond traders swing to Powell's side as Trump calls for rate cuts. Now, remember, Trump did have a go on Powell and say that he wanted to get rid of him, and that caused a little bit of a problem in the stock market because the market did not like that Trump was trying to intervene with the Federal Reserve and start changing who was going to be leading the Fed into the future. And of course, Jerome Powell has come out on top because Trump stepped back a little bit and said, okay, we're not going to be gunning for that, but we do need to cut the interest rates. So what I'm going to do now is explain to you why Trump is adamant that we need to cut interest rates. There's the reason for the US people, and then there's the reason for the US as well. So let me explain it to you. In front of you here, we've got the CME rate swap monitor. Okay, you can join this. It's free to join, and this is the information that hedge fund managers, banks, and everyone, they all get access to this, and it gives us the implied interest rate differential. Okay, so to simplify it, if I want to convert my dollars right now, I can go over to the euro and benefit a 6.78% implied rate differential. After fees and what have you, you're getting around 6.4, 6.5%. That's if I convert my dollars into euros and hold. Right? I can do the same with the Japanese yen, 16%. That's what I'm going to be getting. That is really good news, isn't it? How much of a rate of return I'm going to get if I hold euros or yen. Now, let me just focus on the euro, 6.78%. Well, let's just flip it over to where we are right now with the bonds in the US market. So, in front of you, we've got the 2-year yield currently trading at 3.08%. Okay, 3.8%, sorry. Okay, that's not... Well, okay, that's 2-year. I get that. Then the 5-year, 3.9%. Okay. Then the 10-year, 4.3%. Okay. And then the 30-year, we got 4.8%. Well, I'm getting a much better rate of return on the euro right now, ain't I? So the reason why Trump wants the interest rates to be cut is because money's going over to the euro and it's going over to the yen. Going over to the euro and the yen, you can see right now that the euro is trading benefit of 0.41%, but it has been in a positive move to the upside. And on the back of that, you've got the dollar dominance itself taking an absolute nosedive, and it's just contracting, and the dollar purchasing power is absolutely zilch. Now, if your dollar purchasing power is no benefit to you, in other words, you need to have more dollars just so you can start buying assets priced in dollars, it does make you feel a little bit reluctant to start using dollars, which is why you've got these rates from the euro and the yen, which are way more encouraging to foreign investors. This is why Trump is banging on about cutting the rates. A, to make money start circulating in the economy, but more importantly, get investors to start buying US debt. The problem we've got is US investors are demanding higher rates of return to pick up US debt. 10-year, they want 4.3%. I expect the 10-year yields to keep on moving up. I expect the 2-year yields to keep moving up, and the 5 and the 30-year. So where's the money going? Well, we know the money's going over into the European markets because China's encouraged everyone and its investors, domestic and commercial, to start going into European assets, which explains why the euro is on that trajectory to keep on climbing higher. It's been trending, and this is what Trump doesn't like, which is why he's got it in for Powell to cut the rates all the time. But Powell and the gang at the Federal Reserve are always going to be acting when they get the data. Going into the article, it all goes on to say that with inflation being above the Fed's target, tariffs which can move prices higher, and still a solid labor market, I think the Fed is unlikely to do anything. So that adds more frustration to Donald Trump, where he's trying to put these tariffs into play, which he knows the tariffs are going to lead to inflation. The Fed, on the other hand, is looking at it saying, hold on a sec, man, you're now going to incorporate these tariffs. We're trying to get inflation down. You're giving us another reason for inflation to go up, and you want us to cut the rates. You're going to push us into a recession. We're going to probably get stagflation. It's going to be all over the place, and investors just don't want to take that risk, which is why your yields are going to keep on shooting up, and you've got to refinance $9 trillion worth of debt at higher rates. So where are investors going? Well, we're back to square one. Gold's moving up. Gold is already up nearly 2.35% for the day. Now, the reason why gold is going up is one of two things. One, the expectation that interest rates are going to get cut. Now, we know that Powell and the gang are going to cut the rates at some point, but they need more data. So if there is an expectation of them cutting the rates, naturally investors are going to come away from the dollars and they convert that into assets against the US dollar, like gold. The second reason is safe haven, which means investors don't trust what's going on and they just need to put their money in a safer place because historically that's what they do with gold. Now, with gold being up already so strong for the day, it's telling you what the sentiment is for investors. When you've got the volatility of the yields doing this, it's already telling you that investors are a little bit concerned about where they want to park their money. What about Bitcoin? Well, let's just go over to Bitcoin. Bitcoin right now is currently at the highs and it's doing relatively well. It's doing a nice little pullback after the success of last week's little move to the upside. It hasn't really given us anything. Going into the daily time frame, you can see that Bitcoin does have this green vector candle zone right here, which could be a little bit of a problem. And if you don't know what this green vector candle is and you are new, get over to the Traders Reality website because this is going to help you understand what the hybrid system is. There is a video. It's only a minute, well, just 2 minutes long. And there's a PDF there that's going to help you get started in understanding how to use this system, and then follow everything that goes through. Join the Discord, and of course, this is how you install the hybrid system indicator, the Traders Reality indicator. The two buttons right there are going to give you access to that. Just watch this video and it's going to help you understand how to get it installed and use it for your trading. And if you want to expand on that, then you can go over and become a platinum member under the memberships tab, and you'll be able to get the benefit of setups that I provide every single day for the platinum members, where I project out what I expect from assets like Euro, Gold, NASDAQ, Bitcoin, Ethereum, and Solana, and their trajectory of what they're going to do throughout each trading day. So go check that out. That's in the description if you are interested in doing so. But get this PDF because it's going to lay down the foundation for you so you can understand the hybrid system. Going back into it, Bitcoin, green vector candle right here. It is a bit of a cause for concern, which means that it could actually go down. And people don't like it when prices go down. They only like it when it goes up, which means that you all really want to be buying at the highest price. No, you don't. That's why these guys are happy to buy Bitcoin at these lows. Now, we've had quite a significant amount of buying orders coming into play with Bitcoin. And we've also got a problem down here. We've got some interest at 93,250, where 24 million Bitcoin is looking to get purchased. We had another big order. It was around 30 million down inside of this range. Haven't got it anymore. But I will say that there is interest to sell Bitcoin to the upside. We had this big cluster right here where they sold 20 million. But what we really need to see happening is interest to come in for Bitcoin, or reasons for Bitcoin to go up, to suggest why people will start to sell the Bitcoin as price rises. What reason could we have? Well, look at this. New Whale empties Binance for 50 million Bitcoin. That's really good. I mean, 50 million is not that much relative to the grand scheme of things, but you can see New Whale empties Binance. What do we mean by new whales? Well, that's the problem we've got. A lot of investors that are coming into cryptocurrency right now, they are new, which means that they've got lots of money, millions and millions of dollars, and they're going to try and take a stab at cryptocurrency. They haven't got the old buy and hold mentality because they just want to make money and take advantage of Bitcoin's volatility. Speaking of volatility, we go over to the Arkham. You can see that we're now at an all-time high in principle on the amount of ETFs that we've got. So 607,000 on the BlackRock ETF. So that's showing us that investors are actually accumulating Bitcoin, which could lead us to believe that Bitcoin is primed for a breakout. Going over into Bitcoin's price, go to the daily time frame. As you can see, we are still trading within the 5 and 13 EMA, which is this yellow line and this red line right here. What we need to see happening with Bitcoin is we need Bitcoin to be trading within this range and above the 5 and 13 EMA to suggest the idea that the trend is still favoring higher prices. But the problem we've got is because Trump's coming out with all sorts of news about the tariffs, whether they've got deals or not, it's making investors get a little bit cautious about how much commitment they should actually keep in exposure. That's why you're seeing new whales coming in. They buy Bitcoin and they sell it. And you can see that from this. Go into the order flow and you can see that when we've got Bitcoin consolidating, a rally to the upside forces investors to want to sell the Bitcoin, and they do sell quite a bit of it as well. And then afterwards, Bitcoin tops out and then it rolls back and comes back into the exact zone that they started the accumulation from. So to finalize, who's going to win, Trump or Powell? It's obvious that Powell's going to be the one that's winning. Why? Because the Federal Reserve is the only reason why foreign investors are going to pay attention to whether they should be buying debt or US debt. Now, your dollar purchasing power is zilch, so there's no point in even working your dollars unless you start going into assets against the US dollar, like gold or Bitcoin. Now, nothing's stopping you from buying US stock in the anticipation that the future is going to show that the yield, or should I say, the purchasing power of the dollar is going to start coming back up. But right now, everyone is going into euros, everyone's going into yen because it's cheaper to borrow that money. 2.4% on the euro and less than 0.5% on the yen. Why are you going to borrow at 4.35%, which is what the actual rate is for the US dollar? I understand why Trump's kicking off about it, but Jerome Powell and the gang are effectively looking at the future, because if they do cut the rates, you're going to bring inflation up with these tariffs, and that's going to cause a ruckus. And you've already got a contracting economy, so you're just pretty much setting yourself up for failure, regardless of what the purchasing power is for the dollar. If they do cut the rates now, that's going to force investors to seek even higher rates of return on the yields of the US bond market. So the Fed right now is just trying to keep everybody contained and say, look, we're going to keep the rates as they are right now and let them be satisfied with the rates that they are being offered. But if they cut it down right now, it's going to force investors to seek higher yields. And we could end up seeing the 2-year yield shooting all the way back up to 4.5%. We could even see the 10-year yield trading below that. Or you could have a yield inversion, because investors will then say to themselves, well, I don't think that the future is going to be looking very, very nice. So what we're going to do is we're going to try and see if we can get the 2-year yield to be offered at a higher rate, which means if the 2-year yield keeps on trading higher against the 10-year yield, you've got yourself a yield inversion, which usually and historically implies that we're going into a recession. That's not good now, is it? If you've enjoyed today's video, be sure to like and subscribe, and I'll tune into you all later on. Peace.